Hi, welcome to the InterAxis channel and InterAxis.io. Today we're going to talk about some new investment metrics that we really need around cryptocurrency, around digital assets, around DeFi. And we're not necessarily going to tell you what all those are because I don't think we've established what all of these metrics are yet. But the idea of why we need new metrics and why looking at these through the lens of previous investment metrics, of how previous analysts and previous investors have looked at their investments, have looked at their funds, is not going to work for this new asset class. So first, we want to remind you, please subscribe if you're watching this on YouTube. Follow us on Twitter at InterAxis8. Number 8, and check out our academy, the InterAxis Academy, interaxisacademy.com, where we teach you how to invest safely, how to understand cryptocurrency, how to understand Bitcoin and blockchain and wallets, and also just how to understand it to the point that you might be able to use it in your business, in your life, in your finances, and maybe to start a company, grow a company, and just to understand how this is going to impact your world. But we're going to talk about the need for new investment metrics. And again, we're not the analysts, so we don't really fully want to tell you what these metrics are, but why they are necessary. Because we read on Twitter and all these other media, we read the back and forth about the older investment guard, those that have been in investing for quite a while, those that are fund managers, those that are just maybe talking heads on TV talking about Bitcoin, talking about crypto and that investment and saying, there's nothing backing it. We think it's a scam. It could go to zero at any time. It can be hacked. It's just a bunch of kids, whatever it might be. And understanding that, yes, we just can't use those same metrics we've used in the past to value businesses the same way for tokens, for cryptocurrencies. And here's a little bit about why. So in the past, we might have used metrics, of course, early on investing in companies and businesses, in any place I was going to put my money. If I was going to take money out of my bank account, I was going to have to earn some sort of yield. And that yield was basically going to be some sort of income stream that was going to come at me. And it was either going to be in terms of interest or dividends. That's really what was going to happen. There wasn't an idea really of growth stocks. It was just I was either going to get interest by essentially lending someone money, this is a bond, or I was going to get dividends by putting money into stock, into some company, and when they profited, they were just going to send me a check every year based on the amount of profit and my percentage of the ownership of that particular company. And that's how I was going to make money. Now keep in mind, this was because there was not a robust market. Right? There wasn't a place where I could take my stock necessarily and have an efficient way for someone else to pay me for it. So I couldn't buy a share of stock and feel comfortable that at any point I was going to be able to sell it and get some money out of it, and it was going to have grown. My whole point in buying that stock was I was going to be able to collect the dividends, which is I was going to get to participate in the profits of that company. Now, at some point, there was a more robust market. There was a more robust stock market that was able to price this. We were able to get what's called price discovery. And price discovery basically means myself as the seller and someone else as the buyer were able to more easily agree on a price and figure out how we're going to calculate that price. Now, of course, early on, it was also the fact that it was paying dividends, and I could just take those dividends and figure out what my income stream was going to be from that. Right, so if some particular stock that I invested, that I might want to invest $100 in, was going to pay $10 in dividends every year, I can figure out what that particular stock is worth to me. It's paying me 10% annually. I can figure that out, what it's worth to me. And then what I might do is I might look at this particular company. So let's say this company is, I always go to the General Electric stock. So let's say it's GE, and I might look at GE and go, okay, what is their revenue? What has their revenue growth been? Is their revenue going to, it's been growing at 10%. Do I think it's going to continue to grow at 10%? Will that increase their cost the same, or are costs only increasing by 8%? And therefore, I can extrapolate from that what I think the profit is going to be, and therefore how much I will get as a distribution, as a dividend stream. That is discounting cash flows. That is just discounting the stream of dividends that I might get to arrive at a price for General Electric. Now, at some point during the last 100 years or so, investors and companies figured out, well, maybe companies like General Electric, not General Electric exactly, but maybe companies might be better off not giving me the dividend and just reinvesting it themselves. Because if they keep paying me this $10 dividend every year, well, then I got to go reinvest it in something, and that's not all that efficient, because by the time I get the check and put it in the bank and then go invest it in something else, I got to find something else, and chances are I'm just going to pile it back into GE because that's what I know and that's what's been paying me well. Right. So the better solution is for me is for GE and all the investors to go, hey, instead of taking all that time and money to send me a check all the time, why don't you guys just keep reinvesting it? You're pretty good at what you do, and you can probably get even better economies of scale and better growth if you can just keep investing that money, hence the growth stock. I'm okay with that because I was going to put my money back in your company anyway. And I have this robust market with price discovery, meaning if I have this stock and it's going to grow, instead of being $100, it might be $120 because they're going to get to reinvest. And I know I can go sell it anytime I want because there's plenty of liquidity, there's plenty of buyers in the market, there's plenty of people willing to buy it from me, then I'd rather you just continue to invest in it. And of course, this became even bigger when you had more technology, right? When you had the Microsofts of the world and Apples of the world, who basically said, look, we don't need to pay a dividend. We're better off just reinvesting in what we invest in what we do, and growing what we do, because we can grow at 20 or 25% annually, whereas if we had to pay you a dividend and take that cash off of our books, then we can't reinvest in people and products and better technology. So we're just going to keep reinvesting, and there's a robust market where I can go sell my stock. And I know we're making this very rudimentary, and it's much more complex than that in terms of pricing equities. But we're kind of trying to prove a point here. Now, those technology companies, those growth companies, we had to have new metrics for them. We had to have new metrics to figure out what the price is, because in the past, when you're talking about retail stores, you might have metrics like same-store sales, right? And there's companies that have retail outlets have to calculate their same-store sales, and they look at same-store sales year over year, and we try to extrapolate from that what that means for the price, for the value of this particular equity. You might have things like top-line revenue growth that accounts for it. You might have other metrics that these companies are looking at to kind of determine and extrapolate, here's what the value of the stock, here's what the value of this equity should be, here's what happened to our costs, and you can understand, look, if the government makes a higher minimum wage, here's how it's going to impact these companies, because they have X amount of their labor force's minimum wage, and if that goes up 10%, here's what it's going to do to their costs, and you can figure all that out. Then a big moment, especially in my life, because it was right after, to age myself, it was right after I got out of college when the internet boom really happened. And now you have these internet companies, and they were all losing money, hand over fist, all the time. And the joke was they lose money every quarter, but they make up for it in volume. Right, and that was the big joke, and it was really the big joke among fund managers and among investment analysts, that how can this company Amazon continue to go on like this? They lose money every quarter, and the joke was, well, they make up for it in volume. But the funny thing is that the joke is they did make up for it in volume, and that volume gave them analytics, and that volume meant that they were crushing other retail competitors. And they were understanding what their clients wanted and understanding what other services they could offer. And then all of a sudden, Amazon hits profitability and absolutely takes off. Same thing with Google. Google really didn't have that many ways to monetize except advertising early on. You search for things, they could analyze that, have unbelievable analytics, and as more and more people started using this internet thing and this search thing, and Google had clearly the best algorithm to find you whatever you wanted, then they could take all that data, analyze it, and help you and help with advertising. They could help highly target ads for themselves on the search engine, and then they figured out how to highly target ads to help my business, to help everyone else's business. How can I better advertise utilizing Google? And then you had hyper analytic in regard to search engine optimization. How can I optimize whatever content I'm putting out there so that Google will find it, so that people will find my website without my having to advertise? So now you have search engine optimization companies, okay, and they get really large. Then you have advertising. You have companies that are specializing in online advertising. Okay, but what we had early on in the days of the internet, instead of these kinds of metrics, we called it eyeballs, right? How many people are looking at my website? And that was really the only metric any website, any web company, internet company wanted, was eyeballs. We want more people looking at our website. Eventually we'll figure out how to turn that into revenue. We're not quite sure right now, but the key right now is we want more people looking at our website. Now, a lot of companies went bust because they thought we can just keep losing money and losing money and losing money, and eventually we'll turn it around and figure it out. And they ran out of money before they turned around and figured it out. But the ones who figured it out really did. And then everyone else found out, and everyone else figured out how to grow, how to create profitable businesses utilizing the internet, utilizing the fact that they could sell things online and have hyper analytics, have unbelievable analytics, and target their clients exactly. And I always say, early on, the company Pets.com raised a ridiculous amount of money. They were a public company. They just couldn't sell dog food and cat food and toys and everything online. It didn't work out. They were a colossal failure, and they're the ones that everyone looks at, from the early internet areas as the biggest failure. And the funny thing is, now you can sell highly targeted dog food that is vegan, that is, targeted to a certain breed of dog, and you can make a tremendous amount of money doing that because the analytics are so good. So what we're talking about is the different metrics we're going to have to use and we're going to have to understand as we start talking about cryptocurrency. And some of those metrics we're obviously having to flesh out with Bitcoin, right? So with Bitcoin, we start looking at Bitcoin as, is it a store of value? Is it a medium of exchange? Is it an inflation hedge? And of course, we've seen something like Bitcoin as a store of value. And late, especially in 2020, when hedge fund billionaires started investing in it and said, look, we think there'll be inflation because of all the fiat currency that's being printed. And at some point, once we see that inflation, we'll want something that has a very, very stable supply that we know about to put our money into, because then it will have that same level of inflation or even higher. That value will go up and we'll have more purchasing power. That's the idea of Bitcoin as a store of value. And then companies, a few companies have started buying it and putting it on their balance sheet for a store of value. But how do you account for the fact that with Bitcoin, not only is it a store of value, not only is it something you can put on your balance sheet to offset inflation, but what if you're an international company, right? So what if you're a multinational, like say you're Apple, and you don't have any Bitcoin on your books as of yet that we're aware of, right? But you have banks in all these different countries around the world, right? And you kind of have to keep your cash, and they have plenty of cash. You have to keep it in those banks all around the world, because if you try to move it, you're going to have all sorts of fees, you're going to have taxes, whatever. But what if you could keep Bitcoin on your books, and at all these different banks, all these different locations around the world, you just set up to where that bank can connect and purchase Bitcoin there, and you can hold it. And that way you can easily get money back and forth to wherever you need it in the world. And by the way, it's being held as an inflation hedge. How do you account for that in the value of Bitcoin? We don't quite know how to do that yet. I don't think we've quite figured out how to calculate that as part of the value of Bitcoin. When we start talking about some of the protocols that are out there, the smart contract protocols that are being built upon, the smart contract protocols like ETH, like Tezos, like many of the other smart contracts, some of the metrics that we look at, and the guys, shout out to the guys at DeFi Digital who have gone through a lot of this and figured out a lot of these analytics. Look at how many developers are developing for that, because if part of the value of something like ETH is the fact that it is going to be utilized more for gas to be able to run transactions, well, I want to know who's developing applications now to be able to be utilized later in other applications and other protocols, because that eventually is going to drive the demand for ETH as gas, drive the demand for transactions. So understanding how many developers are building on top of it, not just how many are using it now or how I can farm yield or whatever, but how many developers are looking to build. What are the use cases for Tezos? Is it real estate tokens? Is it security tokens? Okay, then how does that affect, how many real estate firms are even looking at Tezos? How many are interested in it? I can look at things like how much traffic there is, how many searches on Twitter or YouTube or Google for these particular tokens, and that is going to help inform me of what might happen to the value of those particular tokens. These are all new metrics that we haven't had to look at in the past because they didn't really affect the price, they didn't really affect the profit or the value. But sometimes YouTube searches are not just to learn about a token so you can invest in it. It's to learn about a particular protocol so you can actually utilize it. And if you utilize that protocol, that is going to make the token value go up. So again, we might look at how many developers are looking at it. We might look at YouTube searches. We might look at mentions on Twitter. We're going to look in the Discord chats for those particular protocols, because how else are you going to measure? How are you going to measure the value of a protocol that doesn't actually have a leader? That's just a community. How do you measure the value of just a community and what they're doing, and the fact that they can change what they're doing? They can change the governance anytime they want. Right? There's code there that says here's what you're allowed to change, and they can switch up and decide, okay, now we're going to move our money. We're going to start investing in music royalties now within our community, or we're going to create a community for digital art, or we're going to create a community to curate good editorial writing, whatever it might be. How are we going to account for those values? And I don't really know what the answer is. So if you're coming to this video and you're looking for answers, I don't know what it is. But just understand that the investment metrics we've used in the past can't all be used. Now, some of them can be used like cash flow. Some of them can be used to look at applications and protocols like Uniswap and say, okay, how much value do we think is going to be transacted through this automated market maker, this decentralized exchange? How much has been used, how much do we think will be used, and therefore if 0.01% of that gets accrued to the value of the token, and there are X number of tokens, I can figure out how much each token should be worth. However, that still doesn't even get to the fact that on Uniswap, anyone can just go create a token and then launch liquidity on Uniswap. That doesn't account for that on the good side. On the bad side, it doesn't account for the fact that someone can essentially swipe most of the code and create their own DEX, their own AMM elsewhere, because that has happened before, and take a bunch of that liquidity away. So what kind of metrics, the new investment metrics, they're just coming out. We're just at the very, very beginning of starting to understand what is going to drive some of the value in some of these protocols and the tokens that they're associated with. And that is what is going to be really interesting to try to glean and try to understand and look at the analytics and the data on these protocols that are moving so fast and growing so fast, and there's so much composability. They're being built on top of each other, and trying to understand that as we iterate through DeFi so quickly, as it evolves ridiculously fast, what are those investment metrics going to be now, in the next few years, and then well into the future, so that we can understand our investments and understand how we can make better investments, how I can better hedge my investments, because the investors of the future and the financial advisors, as we say, the financial architects of the future, are going to be able to look at that data relatively quickly, create algorithms, figure out what to invest in, how to hedge my investment, and as we say, everyone's going to get a highly personalized and highly customized investment portfolio that now we look at, we think it's crazy, it's all going to be digital, it's all going to be crypto related, it's all going to be sitting on a wallet. But in the future, that's how everything is going to be denoted. Why? Because it's just better technology. It's a better system to account for everything. I'm going to have my real estate, my hedges, my investments in music and art and sports collectibles and cars and companies and protocols, and everything's going to all be kind of mixed together, intermingled, and I'm going to be able to create hedges on that. And I'm going to be able to find income streams if I need to fund my life, or to fund some vacation I want to take, or to fund my kids' college. All that is going to be intertwined, but part of that is going to be understanding the investment metrics that are going to go into it so that I can make really good investments, or the people that I use, the architects that I use, the financial advisors, or the financial advisor algorithms I use are going to be so much better at finding all that and parsing out what the value is of these protocols and of these tokens, because they're going to understand what these new investment metrics might be. Because a lot of the old metrics, a lot of the old guard that says crypto isn't worth anything, DeFi tokens aren't worth anything because there's nothing backing them, or because a bunch of kids playing games, are not looking back to our recent past of the late 90s and early 2000s and realizing they said the same thing about the internet. They said the exact same things, that eyeballs aren't good enough, and if you keep losing money, you're not going to ever be wildly popular, not going to ever be wildly profitable, and that was maybe proper thinking based on what they knew from the past, but it wasn't proper thinking based on this new normal, this new financial ecosystem that was hyper efficient. That this ecosystem, DeFi ecosystem, is hyper efficient at getting funds from one place to another, at getting funds from a place where it's not earning enough to getting it to someone that can earn more with it, and doing so in a very efficient way. That is what we're going to have to understand the investment metrics of, so that we can be better investors into crypto and protocols and DeFi and digital assets of the future. So we hope you enjoyed this relatively lengthy diatribe about the new investment metrics that we're going to need. We hope you'll subscribe. We hope you'll check out the InterAxis Academy, and maybe together we can learn about what some of these investment metrics are. We hope you'll find us on Twitter at InterAxis8, and we'll see you in the next video.